This week, history is being made. The Fed is about to cut rates for the first time in 2025, with the S&P 500 sitting at record highs. Now, that is something we have only seen twice in the last 30 years. But at the same time, stock valuations have reached never-before-seen levels. We have now exceeded the dot-com bubble and even 1929 before the Great Depression. So what happens when red-hot inflation, a weakening labor market, and the biggest tech revolution in decades all collide with Fed rate cuts? I'm about to break it down for you. So on Wednesday, the Federal Reserve will cut rates for the first time in 2025. It is a foregone conclusion. And the reason is the labor market. You see, for the last 4 years, investors have focused almost exclusively on inflation. But that's not the Federal Reserve's only job. The Fed has a dual mandate: control inflation and ensure a healthy labor market. And last week, we learned that labor market is in big trouble. The government issued a revision to the last jobs report. Turns out they overstated the number of jobs created by 911,000. So nearly 1 million jobs vanished overnight. So now they have no choice but to cut rates, because this acts to stimulate the economy. Businesses, consumers, they spend, borrow, invest more when interest rates are lower. It's cheaper to do so. But at the same time, inflation is running hot again. Last week's report showed core CPI inflation at 3.1%, with broad-based rises in prices pretty much across the board. That is 110 basis points above the Fed's long-term target of 2%. So inflation, on the other hand, says don't cut. So the Fed's in a rather unique situation this time around, and all of this is happening in an overvalued stock market. According to data from Bloomberg, U.S. stock valuations have reached their highest level of all time, breaking previous records set in 1929, 1965, and 1999, all of which led to ugly bear markets, the Great Depression, the dot-com bubble, etc. Now, perhaps today's sky-high prices are justified. As I said, we are at the beginning of the biggest technological revolution in more than 20 years. Artificial intelligence has the potential to push productivity through the stratosphere, potentially exceeding what we saw during the Industrial Revolution and the rise of the internet. But here's why this Fed meeting is so unique. This will be just the third time since 1996 that the Fed cut rates while the stock market is at record highs. And stocks have gone up every single time. You see, typically, the Fed cuts interest rates in a weak economy when stocks are already down, just like they did in the 2008 financial crisis or COVID in 2020. And while the strength of the economy is up for debate, GDP growth is booming. GDP is growing at 3% plus per year. So the debate that is probably taking place at the Federal Reserve right now is, do we cut rates by 25 basis points or by 50? The labor market is cracking. The index of U.S. consumers saying jobs are plentiful declined to just 34% in July. That's the lowest level since 2021. This is down 22 points in just the last 2 years. And as we learned last week, the labor market has materially slowed down. But with above average GDP growth, hot inflation, and the AI revolution, the stock market is partying. The S&P 500 just closed at its 24th record high of 2025 and is now up more than 35% since April's low. This marks one of the best 5-month rallies in S&P 500 history, in line with the 2008 recovery. And now rate cuts will just add fuel to that fire. Only 20 times in all of history have we seen this: rate cuts with stocks at all-time highs, and in all 20 occurrences, the market went up. The S&P 500 has risen, on average, 13.9% in the following 12 months, according to data from Carson Research. In the short term, however, results are more mixed. Since 1980, the index went down the next month 11 out of 22 times that this has happened. So basically, over the next 30 days, it's kind of 50-50 which direction stocks go. But over the next year, they've gone up 100% of the time, and by an average of almost 14%. So I expect to see a very similar outcome this time. And listen, I realize that valuations are a bit out of control, but it is hard for me to imagine a stock market decline with above average inflation, which makes stocks go up, 3% GDP growth, makes stocks go up, a once-in-a-generation technological advancement, obviously good for stocks, and the expectation of multiple rate cuts over the next 12 to 15 months. Again, something that makes stocks go up. Now, there will be more immediate-term volatility, but Trump's in office. The markets are always volatile under Trump. Long-term, however, I firmly believe that asset holders will be rewarded. The gold market knows this. It's the same with silver, Bitcoin prices. They have been on a straight line higher for almost 2 years. They are pricing in what is coming. Lower rates into an already hot backdrop will only push asset prices higher. The fact is, it is a great time to own long-term assets. Gold, real estate, stocks, crypto, they're all set to go higher. The long-anticipated Fed week has arrived. I suggest you strap in and get ready for a long bull ride. And if you haven't already, go ahead, click that button down there in the corner to subscribe to this channel. That way these videos will show up in your feed and you won't miss another important update.